Hey everyone, welcome back to another session. In this video, we're diving into the idea of supply and demand zones and breaking down how they stand apart from classic support and resistance levels. We'll walk you through the most effective method for spotting high-probability supply and demand areas using smart money concepts. To wrap it up, we'll go over a confirmation-based entry strategy on the lower timeframes, helping you approach supply and demand setups with greater precision. Mastering this will give you a strong edge, as it aligns your trades with institutional order flow and puts you on the right side of the market. Here's a quick overview of what we'll be unpacking in today's video. If that sounds valuable, go ahead and hit the like button to show some support, and don't forget to subscribe if you're tuning in for the first time. Catch you after the intro and disclaimer. Let's start with the fundamentals. What exactly are support and resistance? Support and resistance refer to price areas where market reactions have occurred previously, and where future reactions are likely to take place again. Now, looking at the chart, you'll see that price moved upward, reached this zone, and then pulled back. This zone is identified as resistance, suggesting that, for some reason, sellers began entering short positions, while buyers exited their long trades. This combination of actions is what causes the price to turn around from that level. Afterward, price dropped, touched this zone, and bounced back, forming a support area. This signals that, again for some reason, sellers closed their shorts, and buyers stepped in with long positions. It's this two-sided reaction that leads to a price reversal from the support zone. Now, why is it important to mark these zones on the chart? Here are 3 key reasons to do so. Reason number 1. Zones where price has previously reacted tend to act as barriers again, so when price nears these zones, we watch closely for signs of a potential rejection. This becomes especially useful when setting profit targets, particularly if those zones align with key levels on higher time frames, since even a minor bounce from them can lead to a significant reversal on lower time frames. Reason number 2. They help in determining market direction. When price breaks above a resistance zone, it suggests that buyers have overpowered sellers, indicating bullish pressure and the likelihood of further upward movement. In the same way, if price drops below a support level, it signals bearish pressure, so it makes sense to align our trades with the dominant trend. That's why checking direction is the first step when analyzing the candlestick chart. Reason number 3. These zones help us identify liquidity areas. It's a well-known fact that when price approaches support and resistance zones, price action traders look for entry signals. For example, break and retest traders may decide to go long if they see signs of rejection at that zone, placing their stop losses below the level, anticipating a further rise. However, if there's insufficient liquidity to support the upward move, the market might dip below the level, grab liquidity, and then reverse back up. So, if our entry is set just beneath that level, it may serve as a double confirmation that we're likely to catch the expected market movement. In this way, traditional support and resistance levels are also viewed as liquidity zones. Now, what is the supply and demand area in smart money concepts? Supply and demand areas form on the chart when smart money enters the market, causing significant price movements. We can't classify it as a demand zone when we see multiple small rejection candles. A legitimate demand zone appears on the chart when the market prints large bullish candles, showing strong buying momentum. These momentum candles signal the presence of major market participants, such as banks, hedge funds, and institutional traders, also known as smart money. In the same way, a valid supply zone forms when the market displays strong bearish momentum through large red candles. So, how do we evaluate the intensity of a price move? We assess this by spotting fair value gaps on the chart. A fair value gap is the distance between the wicks of the first and last candle in a 3-candle formation. The wider the gap, the stronger the price momentum. These gaps represent a temporary imbalance between buying and selling pressure, highlighting that a significant volume of money has entered the market. Price usually revisits these zones to execute the pending orders left unfilled, thus restoring price balance. Now, there's one more factor that confirms whether a supply or demand area is valid: a break in market structure. This break reinforces the momentum behind the move and provides clear insight into the next potential price direction, helping traders make more confident decisions. If you're still not familiar with market structure, we suggest watching our earlier videos on that topic first. You can find the links in the video description. Now, how do we mark supply and demand zones on the chart? Let's begin with the basics. The first step is to spot the fair value gaps and structure breaks on the chart. Once we identify a move that meets these conditions, we define the demand zone like this. Draw a rectangle from the high to the low of the last candle responsible for forming the fair value gap. That candle is believed to be where institutional decisions were made. The same rule applies for a bearish setup. Regardless of the candle's color, we mark the last candle that triggered the fair value gap as the supply zone. Now, different traders may have slightly different approaches when marking these zones, but what really matters is placing your stop loss in a location that's protected from random price spikes. We usually identify three types of supply and demand zones on the chart, based on how the market structure is forming. This includes order blocks, order flow, and consolidation zones. Order blocks are refined forms of supply and demand zones. In this case, we see strong bullish momentum paired with clear fair value gaps, followed by a structure break. The most recent candle that caused the fair value gap gets marked on the chart. Notice how the price collected liquidity just under this candle before making the breakout move. So, the question is, where should we place our stop loss for maximum protection? If we plan to place a buy limit at this order block, the safest zone is under this wick, where the move originated. So we include that section within the order block zone. Then we simply wait for a pullback to enter when a setup is confirmed. In another example here, this is the final candle that generated the imbalance. But again, where's the safe stop? The correct location is above this swing high, so we expand the order block zone accordingly. This adjustment might widen both the trading zone and the stop distance. Later in this video, I'll walk you through techniques to refine your entries in these situations to secure more favorable prices. Occasionally, an order block appears as a differently colored candle right in the middle of strong price action. These are also seen as institutional zones where orders get filled, so we treat them as valid order blocks and watch them closely for price returns. Now, let's cover the second supply and demand type we tag on our charts, order flow. But before that, if you're enjoying the video so far, don't forget to like this video and subscribe if you're new here. Order flow zones are where buying or selling interest builds before a large market move. A bullish order flow happens when bearish pressure appears right before a bullish breakout. Likewise, a bearish order flow happens when bullish pressure shows up before a bearish move. These order flow zones are recognized as key supply and demand levels in smart money concepts. Take this example, a breakout with fair value gaps and a structure break. These two candles represent the final bearish move before price surges. We highlight this as our order flow area. It might span a wide section on the chart and often includes the order block within it. Sometimes, price reverses early and never reaches our original order block, causing missed entries. In such cases, price reacts directly from the order flow area, which shows why tracking structure closely is vital to timing high-quality trades. Finally, the last key supply and demand zone is made up of consolidation ranges. Consolidation zones form when neither buyers nor sellers dominate enough to trend the market. This traps price in a sideways structure, almost like a box, where liquidity builds. Once the breakout happens, that prior range becomes an essential supply or demand zone. Still, we must confirm there's imbalance to validate it as a real zone. Here, for example, price consolidates during the Asian session, and as London session liquidity enters, the price rallies. So that entire consolidation area becomes a great demand zone for long trades. Our stop loss will be safe placed just above this zone, and we can target multiple take profits. But again, like order flow zones, consolidation zones might cover a large area. If we enter at the start of the move and place our stop at the end of the zone, the stop loss can become unmanageably wide. Next, I'll walk you through some of the most effective techniques we use to tighten our entries. But keep in mind, you need to backtest this thoroughly to gain confidence and see consistent results. Now let's go over some of the best techniques to trade supply and demand levels effectively, and most importantly, how to enter at a better price. Checkmark Step 1. Always aim for a minimum 1 to 2 risk to reward ratio. Before placing any trades, make sure your setup offers at least a 1 to 2 risk to reward ratio before price reaches the first target, which is typically the most recent high for buys, or most recent low for sells. If the setup meets this criteria, here's what you do. Entry, at the start of the order block. Stop loss, just below the most recent swing low, or above the swing high in a short position, to give the trade room to breathe. If the order block is a narrow zone, you can afford to widen your stop slightly to avoid getting wicked out by market noise. But when the order block is part of a larger zone, like an extended order flow or consolidation area, we need to optimize further. Gear entry technique 1, mid-zone entry for large zones. Instead of entering at the beginning of the zone entry, place your buy, sell in the middle of the zone. Stop loss, just beyond the opposite side of the zone. This helps reduce the size of your stop loss while keeping your position valid. Pushpin. Why it works. This strategy optimizes your entry, stop, and overall risk profile without compromising the trade structure. Gear entry technique 2, confirmation from lower time frames. This is one of the most effective techniques, especially when trading larger supply, demand zones. Why? Because no matter how clean a zone looks on the higher time frame, the price can still break through without respecting it. So, when price enters your zone, drop to a lower time frame, e.g. 15M, 5M. Look for confirmation-based entries, such as change of character, CHOCH, retracement levels. Break of structure, BOSS, warning key concept, double confirmation is crucial for large zones. When trading large zones, more confirmations are required to avoid getting trapped by false signals. Let's break down double confirmation using the change of character concept. Anti-clockwise arrows. What is a change of character? CHOCH. In a downtrend, price consistently forms lower lows and lower highs. A change of character occurs when the price breaks above a previous lower high. This signals a potential reversal. Now, we don't just jump in at this point. Repeat button. Double confirmation equals CHOCH plus break of structure, BOSS. For a stronger confirmation, we wait for CHOCH, initial reversal signal. BOSS, price breaks the newly formed high, continuing the bullish structure. Then we look for price to retest the demand zone created after the CHOCH and BOSS. This ensures the market is not giving us a false signal. Downward trend chart example. Let's say we're in a clear downtrend on the 4H chart, and we identify a large order flow zone. To avoid a wide stop, we drop to the 15-minute chart. Wait for a CHOCH. But the price may give a false signal and continue upward. That's why we wait for a second confirmation, a clear break of structure, BOSS, to validate the reversal. Once both CHOCH and BOSS are confirmed, we look for entry on the retest of the new demand zone. Tighter stops, higher probability trades. Alright, as always, let's jump into the TradingView chart and walk you through, step by step, what's going on in our minds when a trading opportunity presents itself. Brain market breakdown, EUR, USD, 1H chart. We're looking at the EUR, USD on the 1-hour time frame. Price has recently broken above a key level, indicating a potential continuation to the upside. We've identified fair value gaps, FVGs, which confirm strong bullish momentum. There's also a clear order block, offering a solid long entry setup. Magnifying glass zooming out, 4H chart insight. Switching to the 4-hour chart gives us more context. The area we're watching has acted as a strong higher time frame level, rejecting price multiple times in the past. However, those rejections are getting weaker, signaling possible exhaustion from the sellers. This could indicate an imminent breakout to the upside, even if there's one last weak rejection before it happens. Bullseye trade plan. So, here's how we're setting up. Entry, at the order block level on the 1H chart. Stop loss, just below the zone to stay protected. Target, the close of the latest high. Even if a reversal follows, we expect price to hit that level first. Light bulb additional confluence. The trade gets triggered during the London session, which typically brings in high liquidity. This adds extra confirmation that we're likely to see the move we're anticipating. Check mark wrapping it up. That's it for this breakdown, fam. If you got value from this video, do us a favor, smash that like button to show some love heart. And if you're new to the channel, make sure to subscribe so you never miss a setup. Catch you in the next episode. Stay sharp and trade smart.